This will shock you. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the collapse in interest rates is sending panic across global markets, making this my most important video of the year because as you're about to see, investors, experts, and even the political elites got this all wrong. I'm going to show you everything you need to know. Plus, we have a sponsor for today's show. Hertz Energy is back. You can find them on the CSE under symbol HZ and on the OTCQB under symbol HZLIF. And the reason you want to add them to your portfolio is because in 4 days, China is going to limit the export of antimony. And this is going to be huge because they just acquired a property with antimony on it. I spoke with the CEO this morning and he detailed his plans on how he believes that they could get the stock to double in value. I'll show you everything and why he believes that. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to Bloomberg where we picked today's story up. As two-year yields now fall to the lowest since 2022 ahead of the CPI report, and after the report came out, yields did rise a bit before starting to reverse direction again. And while many people believe that falling interest rates leads to easier financial conditions and will make the case for why the global economy and the U.S. economy is going to experience a soft landing, what I'm about to show you, what it really means is financial conditions are tightening, and for those who are chasing stocks higher, well, this is not the news you want. As treasuries have staged an impressive rally this year amid mounting evidence that a softer labor market and cooling inflation will pave the way for easier policy. These expectations were also bolstered by Jerome Powell's message at Jackson Hole in August, where he said the time has come for rate cuts. And the real question is, why all of a sudden is it time for rate cuts? Is it because inflation hit the Fed's target? Well, it didn't. Is it because the unemployment rate has kind of breached Powell's upper end of where he thought it would go? Well, that's not the case either. It has everything to do with the bond market because the Fed wants you to believe that they are in control of everything, but in reality, they just react to what's going on in the broad bond market here, and we can see that evidence as we look at two-year treasury yields against the federal funds rate. The funds rate shown in blue, and what you can see is every time the Fed cuts, it's because the two-year treasury yields is telling them financial conditions are tightening, you need to lower interest rates. And we could see that here in the late 1980s. We see it here in the mid-90s, even into the dot-com bubble. Once again, the red line leading, funds rate lower. It happened going into the global financial crisis. It happened going into the pandemic. Of course, that was a real reason why Powell cut rates. And now, once again, two-year yields are leading the path lower, and this is causing panic among global markets, and particularly the political elites, because what this bond market is telling them is they've got policy wrong. It's too tight. They need to lower interest rates because what's reality is happening here underneath the banking system, and I'm going to show you this, is financial conditions are tightening. This is not good news for the global economy. It's not good news for the global equity markets either. And the yield on two-year treasury notes has dropped almost 1.5 percentage points from a high in April. The move mirrors gains across bond markets this year as sentiment over the world's growth outlook sours, and this is setting up a global rally. But there's something else that we're seeing a global rally in, and that is antimony, and Hertz Energy now set to take advantage of that as they just acquired a property with antimony. I'm going to show you more, but look at this chart. You're seeing momentum rising across the RSI and the MACD. You're seeing a bottom here, then supported by increasing volume. You see the volume here. We believe that if stock breaks between 6 and 7 cents to the upside, it's heading up here to the 12 and 14 cent range. That would put a cool double your money on your return into your pocket. Check them out on the CSE under symbol HZ, on the OTCQB under symbol HZLIF. We've got more on Hertz Energy later. Now let's talk about the banking system. Let's talk about why falling interest rates lead to tighter financial conditions. Let's start with this chart here. As we look at commercial industrial lending data, we see here the domestic banks tightening standards across firms of all sizes. This shown in blue. And what happens is anytime the blue line is above the horizontal black line, what that means is banks are making it more difficult for people to get loans. And because commercial banks are the only entities in our financial system that can actually create new money by tightening financial conditions, they constrict the creation of credit. Now, what happens then is when the system starts to run out of money, what happens then is interest rates come down. And this is not because banks are buying bonds or any of that. It's because the financial system is running out of money, conditions are tightening. And if you think about it, how do you create money in a system where conditions are too tight? You need lower interest rates, and you need them to go down substantially because you need consumers and businesses to come in and borrow money and spend it into the real economy. And this is why every time we see financial conditions tighten, at some point two-year treasury yields fall. And many people said, Steve, you got it wrong this time because financial conditions tightened and interest rates didn't go down. And that's simply because there was enough money sloshing around the system and people believed that interest rates could only go up. Now we're seeing that trend reverse, which is why we're seeing panic now set in across global markets. The latest evidence came this week as oil slumped and deflation fears intensified in China, pulling the average yield on a Bloomberg gauge of investment-grade government and corporate debt to 3.3%, the lowest since September of 2022. And yet investors appear undeterred by this, and I'm going to show you why they should be flagging this in a big way, because the sale of 3-year treasury notes on Tuesday drew a record amount from a category of investors, and get this, that includes overseas accounts. Now you think about why this would happen. It's because by design of our global monetary system, money flows out of the US into overseas. This is dollars flow over there. Now it's used in global trade, so if there was a lot of demand for products and services, then what you would see is the money being used to buy commodities such as oil to help grease the wheels of global trade. But when foreign investors don't have a place to put their money to make it, they turn back to treasury yields. That's why you're seeing big demand here, because what foreign investors are telling you is a slowdown across the global manufacturing sector is real, and it's not a good thing. And there's a lot of evidence that weaker global demand, is evident by, of course, foreign investors buying treasury yields, is going to lead to a collapse in credit and demand. But let's first take a look at this chart here, because if you want to see how creation of money leads to inflation, we can look at the commercial industrial lending data that's shown on a year-over-year rate of change in blue, and you can see as lending demand increases and money is created in the economy, it leads to an increase in inflation, showed by the consumer price index, that in red also on a year-over-year rate of change. And we can look throughout history and see the constant creation or the increase in creation of credit leads to inflation each and every time. Right now, what we're seeing is just the opposite, as demand for loans is plummeting. And this is happening because financial conditions are tightening. And so how, again, do you get people to go out and borrow and spend? Well, you need interest rates to come down, and come down in a meaningful way. And we can go back here into the early 90s. What happened? Two-year treasury yields, now shown in red, came down. This leads to an increase in demand for credit, but it took a big decline in yields. It happened again during the dot-com bubble, the global financial crisis, even again going into the pandemic. It's happening now. What the bond market is saying is financial conditions are tightening and getting worse, and this is not good for the U.S. economy, and as you're about to see, not good for the equity markets as well. In total, money markets are pricing in more than 110 basis points of cuts to the end of the year and 250 basis points over the next 12 months, which would bring the upper bound of the Fed funds rate down to 3%. The public debate may begin to shift toward a possible dearth of inflation, which would stand to usher in a longer run bullish trend of fixed income, suggesting that bond prices are about to soar, but that's not bullish for the equity market. See, many people believe if interest rates just come down a little bit, that will send stocks soaring, but the evidence is actually just the opposite. As we turn here to a chart of the NASDAQ 100 shown in blue against two-year treasury yields, and you can see big declines in two-year yields lead to bear markets in equities. This is what the bond market is signaling. This is why there's panic now starting to set in amongst global markets, because everybody bought into the narrative that we're going to see a soft landing and a rebound based on a strong and robust U.S. labor market. What the bond market is now telling us is that central bankers got this wrong, investors got this wrong, and even the experts got this wrong. And here we can see core U.S. inflation now picks up, dampening the odds of an outsized Fed rate cut. But I wanted you to see the two-year data first, because what it's telling us is the Fed doesn't actually care about inflation. Now, they say they do, and there are times when they want to care about it, but they care more about what the bond market is telling them. I'm going to show you why. The so-called core consumer price index, which excludes food and energy, increased 0.3% from July, the most in 4 months, and 3.2% from a year ago. Economists see the core gauge as a better indicator of underlying inflation than the overall CPI, but as you're about to see, it means nothing in terms of policy rates. That measure climbed 0.2% from the prior month and 2.5% from a year ago in August, making the 5th straight month of the annual measure has eased and dragged down by cheaper gasoline prices. The BLS said shelter costs were the main factor in the overall advance, but we know the shelter is just an estimate. It's not overly accurate, suggesting that that number is likely to come down in the future, bringing the core rate of change down. But for the moment, you see it actually is fairly elevated compared to where the headline number is going. Many people believe this is going to put the Fed back to a quarter basis point cut. But don't worry, it's about 2-year treasuries. They're telling the Fed they're way behind the target. That's not something that Powell wants to be. And while Wednesday's reading won't deter the Fed from cutting interest rates next week, it reduces the chance of an outsized reduction. I completely disagree with that statement. And even so, policymakers have made it clear that they're highly focused on softness in the labor market, which is more likely to drive policy discussions and decisions in the months ahead. They'll also have more data considered leading up to their November and December meetings, which I believe they're going to cut rates as well. Because the reality of the story is 2-year yields don't just tell us that inflation's coming down. They don't just tell us that equity markets are coming down. They also tell us that we're going to see a rise in unemployment because, again, financial conditions are tightening, which means consumers don't have enough money to go out and spend, which means businesses don't have money to invest. That means everything's about to change, and we're going to see more Americans and more consumers all around the world hit the unemployment line. And there is evidence that the Fed really doesn't care about the core inflation rate as we look at the core rate of the CPI in red on a year-over-year rate change against the federal funds rate. And you can see the Fed cuts rates every time, regardless of what the core rate of inflation is. They don't actually care. What they do care about is what the bond market is telling them. And here we can see the CPI, the headline number, dropped to 2.5%, heading toward the Fed's 2% target. But what we see is a core CPI remained relatively high, but that is not going to last a whole lot longer. The report said it had to do with airfares, apparel, and daycare and preschool, not to mention car insurance costs. We can really focus on daycare, preschool, and car insurance costs being a big problem for many Americans because, look, if you don't have the money, you're not getting on an airplane, staying in a hotel. The reality is those other factors are really putting a dent in the average household budget. That means inflation coming down, demand coming down, and the 2-year treasuries are telling us we're headed right into a recession. A sustained decline in the price of goods over most of the past year has largely been providing some relief to consumers. The so-called core goods price, which excludes food and energy commodities, fell 0.2%. The metric has now declined in 14 of the last 15 months. And so this is a problem for policymakers because according to them, everybody should be doing better, but the data isn't accurate. What we continue to see is despite the data saying inflation's coming down and workers are getting ahead, they're actually not. Things are getting worse for them. And that's what's evident in what the bond market is trying to tell us right now. And central bankers are increasingly paying attention to the labor side of their dual mandate amid emerging cracks in the job market, which are only going to get worse. Hiring over the past 3 months is at the lowest since mid-2020, while job openings declined and layoffs rose in July. Anecdotally, employers have also indicated they're becoming more selective in hiring, with some cutting hours and leaving vacancies unfilled. And those are not the things you want to see if you're talking about a soft landing here at all. Because again, we come back to 2-year treasuries. Now let's look at what happens to the labor market. As we look at the unemployment rate shown in blue, this is the U3 against 2-year treasuries in red. And what you can see is long and sharp declines in 2-year treasuries lead to a rise in unemployment. So this is not the indication of easing financial conditions. This is a sign of tightening financial conditions. You see that happen going into the dot-com bubble. You see it happen going into the global financial crisis. It started to happen heading into the pandemic, which was largely believed to be the beginning of a globally synchronized recession. recession, and now it's very clearly happening again. The bond market is saying it's game over, Fed. You got this wrong. You said you were going to keep the labor market intact, and what we're finding out is they're not able to do that. We're going to see in the very near-term future a sharp rise in unemployment claims. This is dangerous news. Again, we come back to why markets are panicking, because the decline in two-year yield says the bull market in stocks that everyone bought into is about to turn into a massive bear market. And Fed officials also pay close attention to wage growth, as it can help inform expectations for consumer spending, which is the main engine of the economy. A separate report on Wednesday that combines inflation figures with recent wage data showed that real or inflation-adjusted earnings grew 1.3% from a year ago, the most overall in a year. And yet, despite all of that, there's no change in the economy. Things are getting worse. And this is what's bothering policymakers. They're saying the data says that everyone should be getting ahead. They should be outspending, but for some reason they're not. It's because the data doesn't give them the entire picture. And here's the evidence of what they're looking at as we compare the consumer price index against average hourly earnings of production and non-supervisory employees. That's shown in red, both on a year-over-year rate of change. And what you see is average hourly earnings are well above the CPI. The economy should be booming by all accounts, but something is wrong, and the bond market is telling us it's going to get worse. And again, it's not just U.S. yields, it's global bond yields now fall to the two-year low as slowdown fears grow. It's not just a fear, it's a reality. This is exactly what the bond market's trying to tell us, is there isn't enough money to sustain the growth and the asset prices in the global economy. And if rates don't come down and people don't borrow money and create new money into the economy, what we're going to face is an all-out financial crisis. And the oil market is confirming that we're going to see lower inflation due to lower demand for energy. This is exactly what happens when financial conditions tighten. Here we see the CPI against crude oil prices in terms of West Texas Intermediate. That's shown in red, both on a year-over-year rate of change. And you can see again, weaker demand for crude leading to a decline in the year-over-year rate of change is telling us that inflation and demand is coming down, and we're squarely now headed right into a recession, because bond markets are now seeing the risk of inflation falling below the Fed target, which is why now people are saying, well, we're only going to get a quarter basis point cut. In reality, we're likely to get a half basis point cut, and there's going to be further cuts going into November, December, because this time the Fed got it all wrong. But one thing we are very bullish about is not just the direction of we see the bond market going due to the fact we're heading to recession. It's companies like our sponsor of today's show, Hertz Energy, who just made a very strong strategic move. They're looking to send their stock price higher by as much as 100%. I'm going to show you again. We're going to look at that chart. Let's talk about the reasons why, because I had a meeting with the CEO this morning and he outlined their plans. We're very excited about that, and we're really happy to have them as a sponsor on our show. You can find them on the CSE under symbol HZ and on the OTC QB under symbol HZLIF. Let's take a look at Hertz Energy here. And remember, we just featured them, and they're best known as a lithium producer, but they're really going to be now known as an antimony producer, as they just picked up an incredible project I'm going to show you about here in a moment. And they just entered an option to acquire a herein antimony property in Quebec. And this is an exploration stage antimony project located approximately 17 kilometers northeast of the town of New Richmond of the Gaspé region of Quebec. And this region is known for a variety of significant mineral deposits, most notably the mine Gaspé copper mine that is currently under development. The herein property benefits from good road access, hydroelectric power, port access, and nearby available manpower. And look for further updates in the weeks to come on this. The CEO said, Cal's told me, he said, we're committed to keeping updates flowing on what we're doing, because it's also important to know that they have access to flow through capital. And this is a big deal, because as opportunities come up, they have the ability to get it. He told me they have approximately 750,000 to 850,000 in critical metals flow through capital available to them to aggressively explore the herein antimony project. And they're immediately launching a ground surface exploration program in mid-September with the intention to advance the project toward a winter drill program, where you are going to continue to hear more from this company, because again, Cal and the executives are very keenly invested on getting the stock price up. They want to see you make money. This is your opportunity to get into Hertz Energy, again on the CSE under symbol HZ on the OTC under the symbol HZLIF. And here's a big reason why is because let's turn to Reuters with this headline as China fires the latest warning signal with antimony controls. Remember, this is going into effect on the 15th of September. As China's announcement of antimony export restrictions has added fuel to a red-hot market and opens another potential flashpoint with the West for control of critical metals. Antimony is a little-known metal with multiple applications. Its largest end use is as a flame retardant, but also found in solar panels and lead-acid batteries. The U.S. Department of Interior has designated it a critical mineral because it also is essential for armor-piercing ammunition, infrared sensors, and precision optics. The DoD was holding stocks of just 90 metric tons at the end of September 2022, and the annual materials plan for the current fiscal year allows for the purchase up to an additional 1,100 tons. And this is going to be a tough challenge if the world's dominant antimony producer limits global supply. There's an emerging pattern here setting up Hertz Energy to take advantage because antimony prices have soared to record highs this year and nearly doubled, something we think could happen to Hertz Energy stock. And analysts at Project Blue estimate the market was already looking at a 10,000 ton shortfall before China's restrictions. And these new rules don't set explicit limits on exports, but rather require exporters to apply for licenses for dual-use civilian and military materials and technology, a process that typically takes 2 to 3 months in China. On paper, the controls are not targeted at any specific country, but Chinese authorities can refuse licenses to export to individual end-user companies or countries as they see fit. And the U.S. remains critically dependent on China for antimony. It consumed 22,000 tons of antimony products in 2023. Domestic production amounted to just 4,000 tons, mostly in the form of antimonial lead recovered from spent lead-acid batteries and absorbed back into the battery chain. China accounted for 63% of U.S. imports of antimony metal and oxide last year, according to the United States Geological Survey. The next largest supplier is Belgium at just 8%, setting up Hertz Energy to take advantage of this huge shortfall. Let's take a look at their charts here because we're going to come back to the one I showed you earlier. We see momentum rising across the relative strength index and the MACD. We see a bottom coming in here around 2 cents, volume supporting that. You see all this volume right here? Well, the CEO Cal told me that somebody came in and dumped a bunch of shares. They believed that seller is either exhausted or almost done. And when they're done selling, well, that's the opportunity here for Hertz Energy. And why you want to look at getting now, because there's not a lot of resistance in terms of volume until you get to here right around 10 cents, and then it's up there between that 12 and 14 cent range. At the time of filming, where stock was trading just over 6 cents a share, set up an opportunity for you to potentially double your money. And as we zoom into the 90-day chart, you can see the 90-day volume profile line shown in red. You see buyers all underneath here looking to drive Hertz Energy stock price higher. As we zoom into the 30-day, you see buyers are underneath there too, again looking to see this break out. And once again, as we get to the 10-day chart, what do you see? Beautiful volume support here. You see buyers coming in. Once the sellers are exhausted, look to see Hertz stock take off. Could be a big opportunity for you to potentially double your money. But as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.